Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Qingyi Good Night. Today is January 12th, Monday. I'm Huang Pengwei. You all should have seen me on screen and also heard my voice, so let's get started. All right, let's begin. So for today, first of all, we've already arrived in 2026. Congratulations to everyone and Happy New Year. Now, let's talk about what's developed from 2026 up to now, and then we'll take a look at how hardware stocks have been performing. You just saw me on screen, and for this week, there are some important events coming up. First, tomorrow we'll have the December CPI, and the day after that, we'll get the November PPI, retail sales, and December's morning fog sales. Then, on January 15th, there will be the CHA fund data that we have every week. Since the CPI is quite important and is actually the most important data point this week, let's do a quick preview now. Tomorrow night, Tony will be introducing it. So first of all, as for the CPI expectations, YY has it at 2.7, which is the same as the previous period, and the numbers in parentheses are also the same. But for MAN, the actual situation is a bit different. You can see that for MUN, it generally looks like it's at 0.3 right now. But if you look at the core, it has slightly increased to 0.3 as well, but it was revised up from 0.2. So right now you can see it's at 0.3, which is higher than 0.2, and it's still at a relatively high level. So you can see that. Because inflation has remained at a relatively high level over the past 1 or 2 years, and at the moment there's no sign that it's going to drop quickly. All right, now let's look at the US dollar index. As for the US dollar index, it's currently in a slightly weak and fluctuating pattern. And today, before the market opened, because of the current situation, the dispute between the government and Powell at the moment, there are no signs of any significant changes. And 2 years ago, when we looked at the greenback, there weren't any significant changes either. But overall, it's still a range-bound market, and the 10-year yield is showing a similar situation. Next, looking at the 30-year bond, you can see that its yield range is still maintaining that same fluctuation. Now let's move on to the performance of the stock indices. Hey, can everyone see my screen changing? Because on my computer it shows that it's changing, but when I connect to this profile, it doesn't seem to be updating. So I'm not sure what you all are seeing right now. Yes. No screen? Is there a display now? Let me check again. It's still the same, the screen hasn't changed. Hello, everyone. I'm not sure why it's like this right now, because everything looks normal on my end. There doesn't seem to be any problem. You should have seen the opening and the anti-fraud announcement just now, right? So, it's not that there's no display either. Okay. All right, then I'll just go ahead and start. Let's continue. Sorry about that. So 2020 has already started, and we've already gotten through the first week. The first week just passed by quietly, without any major changes. Looking at it now, risk appetite is still lukewarm, not too hot or cold. Today marks the start of a new week, and there's already quite a bit of news. The most important thing is actually about the Fed, and as for Trump's current diagnosis, we can see that the situation is getting more and more intense. Right now, as we mentioned earlier, the most important data this week is the CPI. There aren't any other major data releases, so our main focus this week should just be on the CPI. Currently, the CPI is still at a relatively high level, and it's somewhat difficult for it to come down. However, this should gradually improve as time goes on. So right now, actually, it's just that. Let's first discuss this issue of the deficit. So why do we need to issue a formal summons? It's because this is related to the headquarters renovation. They noticed that the renovation at headquarters created a gap, and compared to the original budget, there was a difference. Tens of billions, in fact. They told me that this could be suspected of corruption or defrauding taxpayers' money. After this incident, or after receiving the summons, Power also became very tough in his stance. He said the government was threatening criminal charges because Bell was making decisions based on the public interest, not the government's will. He also said he wouldn't just go along with the president's preferences, so this is basically how it is. He expressed all the thoughts that had built up during this period, and also shared everyone's current analysis, so it was actually quite clear. His attitude was also rather tough, but he added that whether Bell is under investigation or whether there will be continued pressure to suppress Faye in the future remains to be seen. This means whether the Fed can continue to act in accordance with the greatest interest in the future. If Faye is subject to some kind of malicious interference and cannot act in the best interest, it would have a significant impact on monetary policy and its independence. So what we can see is that right now, they are not continuously pressuring the Fed to achieve this political goal. On the other hand, it also means that the American system is continuously being weakened, and as we just started to take a firmer and tougher stance, a confrontational situation is beginning to emerge. So this is the current situation of the US government, and this is also the most important news tonight. Against this backdrop, you can see that US stock indices and the dollar are both falling, and the volatility of the VIX is starting to rise. So at the moment, you can see that this news should have a short-term impact on the market by distinguishing some risks. What happens next will depend on how this situation develops. This week also marks the start of earnings season, and there are actually quite a few important events this week. One of the key ones is TSMC's earnings call. This call can actually determine whether the current rally in tech stocks can see some pullback and rebound. If TSMC doesn't mention a broad-based increase in demand for tech stocks, then capital might shift even more clearly to other sectors. So what are these other sectors? Well, they could be energy and metals, because right now there's actually a clear trend of energy supply not meeting demand. As long as this continues, and with ongoing infrastructure development and various industrial applications all needing energy, the performance of energy-related stocks will likely see pretty good gains. You can see that in the coming days, a lot of previously popular stocks are starting to show clear upward trends again. And even before that, some of the larger energy stocks, which might not have performed for a while, are now also showing corresponding good performance recently. So that's one part. The first is energy. The other is metals. Now, why metals? Metals are still a direction to consider because they have this very important characteristic as a safe haven. And since they also have real practical uses, what we're seeing right now is that the political division of labor is very uncertain, and then in a context of high volatility, metals will always have this safe haven characteristic. They will attract alternative investment demand, and at the same time, their real-world uses provide support. So that's the current situation. Next, let's talk about space. So after discussing the energy foundation, the next topic is space. So what's the situation with space? The US and China are in a white-hot space race, and the big headline this year is that SpaceX is going public. As for NASA, it will restart its missions this April. This means the US is getting serious about traveling to and from space, and there are some corresponding plans in place. So why is space important? Because space is actually an extension of national defense and security. It's considered part of a nation's resources, involving the use of boundaries and the concept of territory. Whoever controls space will have corresponding power and authority. That's why space and national defense are usually considered together. After this white-hot space race, the space sector could very well become mainstream. Looking at it from today's perspective, space is still somewhat like a small branch within national defense. But if the space industry matures, then many space-related stocks will gradually attract more attention. Through the broader national defense sector, there will also be more opportunities to benefit. In addition, there are some geopolitical news stories, such as Iran, for example, has already fallen into large-scale turmoil, and at present there is a possibility of regime change. The most significant impact of this is actually on energy and geopolitics, and it doesn't have a direct effect on the stock market. Another example is Greenland. As for Greenland, Trump has been relatively clear that he might want to have some means to take control of Greenland, but it's unclear what those are. Right now, Europe is starting to get relatively tense. There was some news over the weekend that the UK and Germany are suggesting stationing troops in Greenland to respond to the threat from the US, and they've also communicated this to the US. NATO still has some operational necessity, urging everyone to unite and possibly handle this matter together. This, in fact, is a sign of internal division within Europe and the US, and its significance is even greater than the earlier news about Iran, because right now, if Europe and the US continue down a path of divergence, since Europe's current defense capabilities are still much weaker than the United States, this also brings some long-term opportunities for our investments. In addition, there is another piece of news. Today, the United States has some key cabinet officials gathered to discuss how to secure the supply chain for optical fiber minerals outside of China, as well as their safety. This is actually quite important as well. As for these critical minerals, we've mentioned them before, they can be produced on a large scale. They can be mined, but at present only China is capable of both mining and refining them. So going forward, the focus will actually be on energy metals, critical minerals, and space. These four areas are all quite promising and important fields to consider. So aside from technology, these are the four main investment themes. That's the current situation. And recently, there's also another one. As for sectors we can look at, this is mainly a recommendation. And this is also the first and second topic for today. Since I can't display the slides right now, after the live stream ends, I'll upload the slides to the Eagle group again. You can take a look. There's actually quite a lot of content in there. You can use this information as a reference, so it should be helpful for everyone's investments. So why are we talking about this? Parts, right? Well, we all know that there's something really important this year, which is the midterm elections. The midterm elections are all about addressing some cost of living issues. So which aspects of the cost of living do people feel the most? Basically, it's student loans, housing, and healthcare. These are issues that most people inevitably face in their daily lives. Most schools are public or receive government subsidies, and schools aren't really profit-making institutions, so let's set that aside for now. As for healthcare, hospitals aren't really profit-driven institutions either. In essence, or let's say if you're at a hospital and you want certain services, it's just that. It's not a purely commercial setting. So why is housing different? Because housing has a dual nature. The house you buy isn't just a consumer good. It's not just something you can live in. It's also an investment product. If you don't live in it, for example, you can wait for its value to increase. So real estate itself actually has this dual nature. It's a commodity, but it's also an investment product. That's what makes it different from education and healthcare. Those two things, like education and healthcare, are more like social welfare. But when it comes to housing, it actually has even more of this investment attribute. So what's the situation now? Right now, because we're heading into an election, there will be more policies introduced around affordability before the election. On top of that, in the US, this is usually the peak season for sales. So at the moment, there are actually some opportunities, but these opportunities are relatively short-term. That is to say, right now we're in the first phase, or the construction stocks are in the peak sales season. The sales data might be released around March or April, and by then this phase will probably be over. There will be a wave of upward opportunities, and it's also possible that this increase might be delayed until just before the financial news comes out, which would be around the second quarter. As of now, the major financial institutions are estimating that the U.S. economic growth rate this year will be between 2 and 3%. But the U.S. government itself is very optimistic. They believe that the economic growth rate could reach 5 to 6%, so they're actually giving a very optimistic outlook. That means they will introduce corresponding policies, and it just depends on how they go about achieving that. So what comes next? As for real estate policy, there have already been some concrete news reports coming out. Last week, Trump instructed Fannie Mae and Freddie Mac to purchase $20 billion worth of MBS. These are bonds linked to interest rates, aimed at increasing liquidity in the housing market, which pushes up bond prices and thereby lowers interest rates, ultimately reducing the borrowing costs for people buying homes. Now, even though this $20 billion only accounts for about 2% of the U.S. housing market, it will have a stimulating effect and can drive widespread demand. What I see right now is that the government's policy focus is shifting toward providing affordable housing and increasing supply. In the past, many real estate companies shifted to an asset-light model, and that led to a lot of pitfalls. A lot of the cash, instead of being used to build houses, was actually used for things like stock buybacks for shareholders, or to boost their ROE and EPS numbers. So right now, the direction is that all this money, or rather the flow of funds, needs to be redirected first and foremost, to actually support production, rather than just engaging in financial maneuvers. As for home builder stocks, there are mainly 6 of them. Let me read them out for everyone. The first one is DHI, which stands for D.R. Horton. This company is the largest residential developer in the United States. They also specialize in building entry-level homes, and their sales volume is very high, the highest in the industry. Next is PHM. This company builds a wide variety of home types, whether it's for first-time buyers, people looking to upgrade, or even for retirement living. They cover it all. As for this company, its distinguishing feature is its strong financial performance and highly efficient capital allocation. Especially in the Sun Belt, they have a lot of projects and are very well received. Next is Toll Brothers, which you might have heard of. They're a luxury home builder, and their stock ticker is TOL. This company their main business is building luxury homes. Now, as we can see, the current situation is actually that the mortgage rates on existing homes are relatively low, but if you want to buy a new home, you'll have to take on a much higher mortgage rate. So the sales volume, or the number of existing homes on the market, is quite low, and in the luxury home segment, there are even fewer competitors. So if you want to buy a luxury home, most likely you'll end up buying a house built by Toll Brothers. These luxury homes can be sold at higher prices, so their gross margins are higher, and they have a certain degree of pricing power. Another company is Lennar. So what about this company? It offers a full range of residential options, meaning that within the homes there are many tech features, and maybe even the furniture is all designed for you, and so on. This company also has corresponding growth potential. However, compared to D.R. Horton, or DHI, the homes this company provides are not as cheap or as accessible to the general public. And it's also not as entry-level. So under the current policies, this company might not benefit as much as DHI. Now, that company is NVR. As for NVR, it's actually a very unique company because it's basically a land buyer. No, actually, it's a company that buys land rights, not the land itself, so it doesn't have the same land risk. That makes it a relatively good defensive real estate stock. But for now, you can probably skip this stock, because in terms of investment, its performance is more about risk aversion rather than appreciation. Lastly, there's Sky, or Skyline Champion. This company is quite unique as well. It's a leading player in modular and prefabricated homes. So as for this company, it uses a modular contract manufacturing model to build houses. Hey, if you're a global investment securities client, you can join the LED group, and a broker will send you my daily briefings. After this live stream ends, I'll send the wallet to everyone. I'll send it to the group, and then ask the broker to forward it to everyone. Sorry about that. Okay, lastly, let's talk about Sky. This company can very quickly build houses on a large scale. So it will also be a beneficiary of the current policy environment. What trends can we see from this round of policies? First of all, housing is a very clear issue, and unlike education or healthcare, it has some investment characteristics. Next, as for Trump, he has already given clear instructions for the semi-official entities, Fannie Mae and Freddie Mac, to increase liquidity in the real estate market and lower interest rates so that people can afford to buy homes more easily. Since affordability is the main concern right now, there won't be a significant increase in demand for luxury homes or new brands or anything like that. The greatest increase in demand will probably be for homes with better amenities, or at least the highest demand will be for those. The shift in demand will mainly come from relatively affordable entry-level homes. So at the moment, the companies most likely to benefit are DHI and Sky. You can take a look at these two companies. DHI is more like a relatively mature company. As for Sky, it's a relatively aggressive company with more growth potential, so it could be a promising target. We'll show you some charts for reference, but they aren't loading right now. Also, since this news was already announced last week, the trading day was actually the weekend before last, so about 4 or 5 days ago. Actually, all of these stocks have had a pretty clear rebound, a very obvious rebound, but the extent of this rebound is still quite limited. If you look at their performance over the past 6 months or the past year, they're still basically moving within a range. So that means everyone is still... So recently, there has been some room to enter the market, but it's also possible that these stocks might experience a slight pullback in the near term, because, for example, in the last couple of trading sessions, they've gone up quite a bit. Going forward, you can keep an eye on these stocks by adding them to your watch list. As for what comes next, if you're not looking to enter immediately, you can still consider getting in and riding this wave. First off, you can look at DHI. Right now, it's still positioned within a relatively low range, near the lower end of its range. The PA line has jumped up, but it's still quite low as well. For the most part, it's already above all the moving averages. TOA is in a similar situation. TOA has been consolidating for quite a while. As for TOL, in my opinion, its investment value is currently lower than that of entry-level homes, because people will still choose to buy entry-level homes before luxury homes. Plus, luxury homes are mainly bought by wealthy individuals, and there just aren't that many of them, so the demand is limited. The market share itself has certain inherent limitations, so you should think about your investment goals. Some companies are good companies, they're solid, but their growth may not necessarily be reflected in the stock price. So you need to consider why you want to buy this company. If you're looking for investment, specifically capital gains, then in my opinion, TLL is not the best choice at the moment. Also, as for X, L1 and L1N are still okay, but you can see that LIN is actually in a very low-end contrasting situation. At the moment, the relatively more stable ones are still DHI and Kai. As for NVR, this stock is actually very expensive. It's already over $1,000 per share. Right now, it seems more like It's a special type of investment product, and it's not necessarily a suitable target for everyone to invest in. We're just listing it here for your reference, because this company is quite unique. It buys land rights, but it doesn't have the risks associated with owning the land itself, so its nature is quite different from others. Lastly, there's SKOSI, which actually has the best stock price performance. At the moment, it's also continuing to hit new highs. Now that we all understand its business model, going forward, you can refer more to technical analysis for your trading decisions. This approach will help you act more quickly. Or rather, it's a more direct way to achieve some results. A clear trading method, because a lot of the time, once you're pretty certain about the fundamentals and there aren't likely to be big changes, you can mostly rely on technical analysis for your trades. After all, the fundamentals usually don't change drastically in the short term. All right? In addition, aside from real estate stocks, There were also two related stocks. One is HD, Home Depot, and the other is Lowe's, So you can keep an eye on these two as well, since they tend to benefit from the real estate market. Alright, next, let's take a look at the current pre-market strong and weak performers. At the moment in the pre-market overall, one of the stronger stocks in the market right now is TIM. As for TM, because it had been stagnant for quite a while, and after the earnings report was released, it saw a significant increase. So this is a rebound after being down for a long time. Currently, there aren't any particularly notable stocks on the declining side, so let's take a look at the S&P 500 situation. So the current topic is, there's some news today that Trump mentioned something about credit cards. The annual interest rate on credit card debt can exceed 1 year, can't go over 10%. Actually, credit card interest rates are usually very high, often in the high double digits. 20 or 30% isn't unusual. Now, he wants to set the interest rate on credit card debt below 10%. Otherwise, it would be considered illegal. Because of this news, many financial stocks in pre-market trading, like Citi or JP Morgan, have been affected. And Bank of America is also seeing a significant drop. Companies in the buy now, pay later sector, like Klarna or Affirm, are also affected. So right now, what can we see from this? Basically, the Trump administration has always claimed that it governs with common sense. They say it's practical and very pragmatic, but behind this pragmatism, there's a lot of uncertainty. So what's the best thing? It's certainty and predictability. In the market, predictability is the most valuable. If you don't have predictability, there's a lot of volatility, and people can't anticipate what's coming. Without predictability, the chances of a bull market are also much lower. But even if we have predictability, no matter how many emotional policies or light touch market policies there are, it's still futile. We can see that recently the reason why the market has been so volatile is because the Trump administration has become increasingly. One day he says this, then he wants to do that, or he says he wants to do something else. Recently, there have been some particularly unusual ideas, and the direction has started to become rather unique. There isn't a coherent or complete system in place, like having a clear plan for what needs to be achieved over a certain period, or patiently pushing forward certain initiatives, or having a clear ideological focus or policy direction. There isn't a clear mainstream approach. It's mostly vague, talking about light touch policies and development. But these are actually pretty empty concepts. You really need to have corresponding plans as well as a detailed timeline to follow. Let everyone understand what kind of development you want to pursue, or what further steps you want to take, or if you want to reset America, how exactly do you want to restate your intentions, or what exactly do you want to do? What is the specific timetable or plan? But they don't have that right now. At the moment, it feels more like they're just doing whatever they want, whenever they feel like it. This actually creates a lot of uncertainty in the market, but that's just how things are right now. You could also see why it seems like this is the case. Under the current business policy environment, whenever they announce measures that seem to focus on protecting consumers or looking out for more people, the stock prices drop. That's also the situation right now, so that's how it is. Right now, these two pieces of news are particularly sensitive. Next, let's talk about the tech sector for a bit. As we just mentioned, space, energy, metals, key minerals, and components are all groups that have had opportunities to perform well recently. But what about tech? Actually, tech hasn't really shown much performance lately. But in the past few years, tech has always been the hottest investment theme. And we also predict that by the end of 2025, tech will still be a part of investment portfolios. However, at the moment, actually, the performance of tech hasn't been particularly outstanding, even since the start of 2026. So how can tech be boosted going forward? Right now, among tech stocks, equipment is doing relatively well. One area where equipment is performing better is in the demand for semiconductors. Also, there were some sectors that had lagged behind before, so going forward for tech stocks to keep improving. One thing is that overall demand for tech needs to pick up, and another is that tech companies must now present real sources of profit to convince investors. In the past few years, the tech boom was often driven by expectations, but now that phase of expectation may have already passed. In other words, the easiest time to invest in tech stocks may be behind us. This year, it looks like capital will flow into various sectors beyond just tech. Especially as we just mentioned, sectors like energy, metals, and critical minerals are key areas. Additionally, funds will also flow into international stock markets. As we've discussed, European stocks have been very strong recently, and the breakout trend in European stocks is very clear on the charts. Lately, more people have become optimistic about European stocks, and it's likely that European stocks might take a short break before moving higher. But for now, the situation is as follows. This week, starting from January 3rd, the first thing we'll be watching is whether the tech sector can actually deliver real profits. Also, with earnings season kicking off this week, bank stocks will start to show their performance. So, how will everyone perform? Will they be able to meet expectations? Next, looking at the current situation, the indexes are still in a relatively large fluctuation range, without any clear direction. So, we'll have to see if, after this earnings season, the stock indexes will show a more obvious direction, meaning an upward trend. That's all for the update. Good night. Thank you all for watching.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.